Okay, let's get right into it. We're going to connect two things that seem like they're on opposite sides of the planet: a tiny little shipping lane in the Middle East and the price you pay for food at your local supermarket. Believe it or not, this connection reveals a kind of hidden inflation, and it really drives home a huge idea for the next decade. If you don't understand the supply chain, you're going to end up paying for it at the checkout. We have all felt this, right? You look at a menu and the prices just seem to be climbing nonstop. But the most important part of this sentence is actually the second half. It points to something called menu lag. You see, a restaurant can't just reprint its menus every single day. So when their costs for beef, for cooking oil, for the wheat in the buns suddenly spike, they have to absorb that cost for weeks, maybe even months. And that right there, that's a bright, flashing warning sign of some serious pressure building up deep inside the global supply chain. And hey, if you've ever thought to yourself, the news says inflation is, 3%? But my grocery bill feels like it's up 20%? Listen, you are not going crazy. The official number you hear on the news, the Consumer Price Index, or CPI, it often leaves out food and energy prices. Why? Well, they say they're too volatile. But for you and me, our grocery and gas bills aren't volatile extras, are they? They're our core, non-negotiable expenses. This slide just perfectly shows that gap between the official story and your actual real-world experience. So if the official numbers aren't telling us the whole story, where do we look for clues about what's coming next? Well, surprisingly, the answer is on a map. We're about to zoom in on one of the most critical and frankly combustible spots on the entire planet. To really understand the risk here, we're going to game out a scenario. Let's call it the 2026 Hormuz crisis. Now, this is a fictional scenario, but it's based on very real-world tensions. Let's imagine a conflict escalates, and it results in a full blockade of the Strait of Hormuz. In an instant, the most important artery for global energy is just clamped shut. And this is not a regional problem, folks. This is a trigger event for immediate and severe global consequences. Let's start with this number, 20%. It might seem simple, but this represents a foundational pillar of our entire modern economy. 1/5 of all the oil traded on planet Earth has to pass through this one narrow strait. When that flow stops, the price of literally everything that needs to be made or moved is immediately at risk. But it's not just about gasoline for our cars. Oh no, this next 20% is arguably even more critical to our daily lives. 20% of the world's liquefied natural gas, or LNG, also sails right through Hormuz. This is the fuel that generates electricity and heats homes from Europe all the way to Asia. A disruption here means the lights could literally go out. And here it is. This is the number. This is the absolute core of what we're talking about today. 1/3. A full 33% of the world's seaborne urea, that's a key nitrogen-based fertilizer, comes through this exact same choke point. Look, oil and gas keep the economy running, sure, but urea is what actually grows the world's food. So the crucial thing to get is how a military event in the Persian Gulf finds its way to your dinner table. The chef and humanitarian Jose Andres has pointed this out a lot. Food is one of the first and most direct casualties of any conflict. Let's trace that direct and brutal chain reaction. Let's just walk through how this chain reaction builds. Step 1 is instant. The blockade happens, the ships stop. Step 2, with supply just choked off, the global market price for both natural gas and that urea fertilizer just explodes. Step 3, farmers who absolutely depend on both see their operating costs go through the roof. And finally, step 4, that cost has to go somewhere. It lands right on the price tag at your grocery store. This is not a theory. It is the simple, unavoidable math of the global supply chain. Okay, so understanding the problem is step 1. But for an investor, every problem presents a potential opportunity. If you can see this specific type of inflation coming, how could you position yourself not just to survive it, but to maybe even benefit from it? This right here illustrates a really key investment concept: non-correlation. In a crisis like our Hormuz blockade scenario, what happens? Investors freak out about a global recession. They sell stocks, so the Dow and the S&P 500 fall. But at the exact same time, what's happening to the physical price of corn and wheat? It's going up because the cost to produce it is skyrocketing. You see? While everyone talks about gold as a hedge, agricultural commodities can move in the complete opposite direction of the market for very real, very tangible supply and demand reasons. And this is the core idea we're exploring today, the hunger hedge. It's a strategy that's built on a pretty grim reality. No matter what the stock market does, people still need to eat. So when a geopolitical event creates a real physical shortage of the things we need to grow food, the price of that food can become totally disconnected from what's happening in the broader financial markets. So how does a person actually approach this? Well, it's not about just randomly buying some agricultural fund and, crossing your fingers. Professionals think in terms of a very clear, disciplined plan. This simple little diagram, it might just be one of the most important concepts in all of investing. Before you ever put a single dollar at risk, you need three things. First, your entry. Why am I getting in right now? It has to be based on specific criteria. Second, your target. What's a realistic price for me to get out with a profit? And most importantly, your exit, your stop loss. If I'm wrong, at what predetermined price do I get out to protect my capital? No questions asked. To really get how these markets work, let's just step away from trading for a second and look at a real-world problem. A farmer's entire year, their whole livelihood, hinges on the price of wheat when it's time to harvest. So let's say his break-even cost is $6 a bushel. But when he harvests, the market price is falling to $4. He's wiped out. It's just total, unacceptable uncertainty. So what can he do? He can use financial tools to take back control. He can enter a contract that gives him the choice to sell his wheat at his break-even price of $6. This guaranteed price is called the strike price. It's the price at which he can protect his farm from a market crash. He has literally struck a deal to lock in his price. Now that choice, that protection, it isn't free. To get the right, but not the obligation, to sell at $6, he pays a small fee. We call that the premium. You should think of it exactly like an insurance premium. He's paying a little bit of money to protect himself against a catastrophic loss. And get this, if the market price soars to $12, he's not forced to sell at $6. He just lets his insurance expire and sells his wheat for $12 on the open market. It gives him power and control. Okay, we've covered the geopolitical risk, the supply chain connection, and the framework for potential hedge. But now we have to cover the single biggest trap that unwary investors fall into when they trade commodities. And I mean it. Getting this wrong can completely destroy your capital, even if you were 100% correct about where the price was headed. So the seemingly obvious move for most people is to think, okay, great, I'll just go buy an ETF that tracks oil or natural gas or corn. I mean, it feels simple, right? It's accessible, it seems direct. But there is a hidden wealth-destroying machine grinding away inside most of these products that you absolutely have to understand. The killer is a concept called contango. In a normal market, a contract to buy a commodity in the future usually costs a little more than buying it today, because of storage costs and stuff. These commodity ETFs, they don't hold physical barrels of oil, they hold these futures contracts. So every single month, they have to sell the contract that's about to expire and buy the next month's contract. In contango, this means they are mechanically, systematically forced to sell low and buy high, over and over and over again. It is a guaranteed slow bleed of your investment. And look, this is not some small theoretical thing. This is the brutal, real-world data for two of the most popular commodity ETFs out there. The United States Oil Fund, USO, has lost an average of 18% per year, every single year since it was created. The Natural Gas Fund, UNG, is even worse, losing an average of 31% annually. This decay happens no matter what the spot price of oil or gas does. It is the inescapable, brutal truth of contango. So let's bring it all together. What are the crucial points to walk away with? First, the inflation you feel at the grocery store is real, and it's often invisible in those official statistics. Second, geopolitical choke points are not abstract risks. They have a direct line to your wallet through critical things like fertilizer. Third, agricultural commodities can offer a powerful, non-correlated hedge in these specific scenarios. And most critically, you must understand how your investment tools actually work. Buying and holding a futures-based ETF is a near-certain recipe for disaster because of contango. Which leaves us with one last question to think about. As our world becomes more fractured and supply chains get more fragile, is a deep understanding of how things are grown, made, and moved the single most important investment theme for the years ahead?